In the book Fight Club, author Chuck Palahniuk made the observation that, on a long enough timeline, the survival rate for everyone drops to zero. This is a truth that everyone eventually must come to terms with. While it's tempting to wax philosophical about the nature of death and our finite time on this planet, that's not what I'm going to do in this video. I'm here to talk about some practical considerations that affect the living. Yes, one of the only things that we can assume with any certainty is that one day we are going to die. However, nobody knows exactly when that day will arrive, save those who decide to take their own life. Until that day of reckoning comes, we must have wealth. Yes, wealth is something that you only need just in case you don't die tomorrow. So since you have no idea how many tomorrows you have left ahead of you, how can you know how much wealth you are likely to need today? Well, there is a way. Let's talk about it. Here is a graphical illustration of what those in the pension and insurance industries call an actuarial table. It shows statistically how long random people selected from the total population can be expected to live given that they've reached a certain age. For example, we can see that a male who has reached age 60 can be expected to live another 21 years, or to approximately 81 years of age. A female who has reached age 60 can be expected to live another 24 years, or to approximately age 84. Of course, while this is the expectation, it's not a guarantee. Some won't be so lucky to make it to those ages, but some will make it much further. For example, we can see that of those who make it to age 90, whether male or female, there is still an expectation that they will make it another 5 years before death, and still, that is no guarantee. The information contained in this graph is like the Bible for the pensions and insurance industry. It is the starting point for estimating life insurance premiums. It is the basis for calculating annuity payments. It is information that is critical for determining funding needs for pension plans. These industries can make some very reliable calculations based upon this information because when averaged over a large number of people, the life expectancy calculations are highly reliable. Now, to the person planning to retire at some point in their life, this graph can also be very important, but it can also be a little misleading if you don't use it properly. For example, if you are a male and have enough wealth to last for 21 years, it is tempting to conclude from this graph that you can stop working at age 60. But this could potentially be a very unfortunate assumption. As it turns out, making this assumption leaves a person with a very high probability that his wealth won't survive for as long as he does. So let's take a look at why this is true. Here I've delved into the death statistics a little further to show for a current 60-year-old what their probability is of making it to a certain age. We can see that 50% of current males aged 60 make it to age 81, while 50% of females aged 60 make it to age 84. No big surprise there. That's pretty much what the life expectancy information told us. So our male, who had 21 years worth of wealth saved up and decided to stop working at age 60, has a 50% chance of the decision being a good one, and 50% chance of the decision being a poor one. I don't know about you, but personally I'm uncomfortable with a 50% chance of outliving my wealth. Let's go out a little bit further. Notice that our 60-year-old male has a 10% chance of living as long as age 93 and a 5% chance of living as long as age 96. So what can we conclude from this is that if our 60-year-old male wants to be reasonably sure that he can stop working, he'd need to have about 33 to 36 years worth of savings, not the 21 suggested by the actuarial tables as the average life expectancy. This is quite a difference. A woman age 60 would have to have even more savings because she might live to an age of 96 to 98. This is not a problem for the insurance company or a pension because for all of those who live longer than expected, there will be many who live shorter. But it's certainly a big problem for our individual who would like to retire. So what kind of advice does the investment industry give to our individual? Often we hear the investment industry telling the individual investor that they should hold a portfolio that contains 60% stocks and 40% bonds so that the person can be sure that his or her funds will be sufficient in retirement in the face of inflation. Is this good advice? Let's put it to the test and find out. What I'm showing here is data going back to 1871 as provided by Robert Shiller. I constructed an index consisting of 60% stocks and 40% bonds. Assuming an investor had a time machine and invested $1 in this index in 1871, here's how that dollar would have grown in constant 2014 dollars over time. I'm plotting this index on a logarithmic scale so that constant growth shows up as a straight line. To someone who is not very skeptical, this can appear on the surface to be a very compelling reason to hold a heavy percentage of stocks in retirement. And maybe that's why the money managers promote this kind of graph so heavily. Remember, money managers earn commissions, and they're probably going to value their fees and commissions more so than they value the welfare of their clients. And so let's examine some of the factors that the money managers are likely to omit, which are of critical importance to the individual who needs to use their wealth in retirement. We'll ignore the effect of taxes for now, and just to keep the analysis as general as possible. This will be a fairly generous assumption, but the point I will be making will still be made abundantly clear. We'll deduct taxes upon withdrawal later. We'll also ignore fees. While fees can be quite large, low-cost index funds are available to most investors, and so we'll give our investor the benefit of the doubt and assume that the low-fee option is selected. This leaves us with one very big problem to discuss, and this is the core issue of this presentation. Namely, that the individual is not an insurance company or a pension fund, but a person with a very short time horizon. While the average rate of return on this portfolio is 5.2% per year, the individual investor isn't going to take his withdrawals over the course of a century. The individual investor is going to take withdrawals over at most 35 years, and the funds need to be available whether the market is doing well or doing poorly. We can evaluate the individual investor's chances that his or her funds will survive a 35-year period of withdrawal by performing what is called a Monte Carlo simulation. What we will do is pick random starting points to start a 35-year retirement with constant withdrawals and see how well the person fares in all possible scenarios. Let's start by assuming the investor has a nest egg of $500,000 accumulated in a 401k plan. We can see how the investor will fare for various rates of withdrawals under all possible futures. But first, let's see what the investor could afford to do if the returns from the portfolio were perfectly consistent and uniform at 5.2% per year, as the average long-term financial market results imply. Let's assume that our investor has already heeded our lesson regarding the longevity of his life and wants to ensure his funds last for 35 years, just in case he outlives the life expectancy in the actuarial tables. If our investor starts with $500,000 in his account and achieves a perfectly uniform rate of return of 5.2% per year, then the investor can safely withdraw $2,549 per month from the account in constant dollar terms, and the money will be sufficient to last for 35 years. This is a withdrawal rate of about 6.1% of the portfolio starting value annually. Keep that number in the back of your head for a minute. We can see from this chart that if returns are perfectly predictable and consistent, then the investor will run out of money at the very end of 35 years. Thus, there is a very good chance that his wealth will have the longevity needed. It is very tempting to assume that because the 60-40 portfolio returned 5.2% per year historically, that this is the assumption that should be made for retirement planning. But let's see what our Monte Carlo simulation says about the reliability of the $2,549 per month withdrawal rate. Now things start to get real. We've gone back in time and simulated a bunch of real portfolios starting with $500,000 with a constant inflation-adjusted withdrawal rate of $2,549 per month. What we can see is that some of the time, 16% of the time to be exact, the investor would not only not run out of money in 35 years, but would actually have more wealth at the end than when he started. Of course, that really doesn't help our investor any. He's dead. His heirs might care a great deal, but that's another matter. A more important observation is that the portfolio fails about 72% of the time. Our investor is far from certain that he will run out of life prior to running out of money. So what would be a safe rate of withdrawal, based upon what we know about the nature of market returns? Our Monte Carlo analysis can answer that for us. With a little iteration, we can find a withdrawal rate that only fails about 10% or less of the time. So I've done the iteration and found that if an investor starts with a portfolio of $500,000 invested in a 60-40 portfolio mix of stocks and bonds, he can afford to withdraw about $1,525 per month pre-tax on an inflation-adjusted basis. This policy will only fail 10% of the time over 35 years. This withdrawal rate is only 3.7% annually of the starting value of the portfolio, which is a far cry from the 6.1% that would be safe if the returns from the portfolio were completely consistent. And this is a very important difference. It implies that if the investor wants to take Wall Street's advice and use stocks and bonds to cover retirement expenses, he'll have to save much more pre-retirement to make sure that the portfolio doesn't fail him. Any investor can use this 3.7% number to estimate retirement savings needs. Just take your desired pre-tax annual spending need and divide it by 0.037, and it will tell you how much you need to save as a starting balance. If an investor wants to draw $20,000 pre-tax from retirement funds, then he better have a starting balance of $540,000. If an investor wants to draw $50,000 pre-tax from retirement funds, then he better have $1.35 million saved up at the start. And these are very big numbers. I bet Wall Street doesn't want people thinking about just how enormous a person's savings needs are if they want to swallow the Wall Street pill. But there is an alternative that I will make everyone aware of in a moment. You might notice that with such a low withdrawal rate, there is a very high chance that the investor will have quite a high balance left at the end of 35 years. Yes, this is true, but don't forget, our investor is dead. If passing along some money to the kids is important, there are other ways to do it without saving so hard pre-retirement or living like a Spartan in post-retirement. The main message for the investor to take away from this is that without having a very long time horizon, uncertainty can require a huge level of sacrifice on the part of the individual. Wall Street would like us to think that this is not so, but this line of thinking is likely to result in disaster for many current and future retirees. And to drive the message home, let's take the implied safe withdrawal rate that we just determined from the Monte Carlo analysis and see what it tells us about just how much of the 5.2% financial market return our investor with a finite timeline can actually bank on. Let's go back to our hypothetical example where an investor can guarantee a 5.2% real annual rate of return on his or her wealth. We found that in this case, if the investor started with $500,000 and needed it to last for 35 years, then the inflation-adjusted monetary withdrawal rate could be $2,549 per month. But this curve is largely academic for the individual because the individual is constantly making withdrawals, even during the bad years, and thus is going to be very prone to volatility. Our Monte Carlo analysis demonstrated for us that if the investor wanted to be 90% sure his funds would last throughout his lifetime, that he could only withdraw $1,525 per month, not the $2,549 that historic market returns would imply. So if we take these results and put them on the same basis, what does it tell us? Well, the red curve that I added here is the account balance we would see if the investor started with $500,000, earned a 1.5% per year guaranteed real rate of return on his wealth, and withdrew $1,525 per month. Notice that our investor runs out of money at the same time as before. And what does this tell us about the impact of volatility for the individual investor who needs his funds to last? It tells us that he can only safely count on 1.5% per year out of the 5.2% available to large institutions who can weather the bad years. This is a very, very important conclusion and one that you should think long and hard about. The money managers will tell you that you need to have stocks in your retirement portfolio in order to generate the growth needed to make your money last. However, Because of the volatility, you can't count on the growth being of much use to you. If you want to guarantee that you'll avoid disaster, you'll either need to start with a much higher balance or take much smaller withdrawals. The growth may be of benefit to your heirs, but you personally will not be able to take advantage of it and still be safe. But what about gold? I'm constantly telling you about the virtues of gold, and I do believe that gold has a very important place in your portfolio, both in your wealth accumulation phase as well as in your retirement. Can the investor count on gold as his exclusive savings vehicle for retirement? Let's put it to the test. We have a much more limited window of free market data for gold. In the modern times, people in the US couldn't even legally own gold until the early 1970s. But we can still take a look at a number of scenarios to see how the volatility in real returns affects our safe withdrawal rate. Here I use the same Monte Carlo technique to backtest history. An investor starting out with a stack of gold worth $500,000 in today's dollars terms could afford to spend about $1,020 per month in real terms and be 90% confident that his wealth would last him through his retirement. So over the course of 35 years, our investor can spend a little over $428,000 of real wealth if he starts with $500,000 worth of gold. So gold has done a very nice job in preserving purchasing power over time, but the problem is that different people are in different circumstances. For the rich, who do not need to spend their gold, gold does a much better job than for the little guy in retirement who must tap into his gold reserves even when it is inconvenient to do so. I personally think the lack of data points paints an unusually pessimistic view of gold. Remember, we are using a 35-year window of time, which means that many of our data sets will be starting in the late 1970s, which we know was an unusually poor time to have most of one's wealth in gold. In fact, any time the ratio of the price of gold to the price of oil climbs above 20 barrels per ounce, gold can be considered to be quite expensive in real terms. Since gold is currently between 12 to 13 barrels of oil per ounce, the data sets from the late 1970s aren't very relevant to us today. But there are methods that are statistically legitimate which we can use to eliminate these unreasonable starting points from our analysis. Up until now, I've been employing a non-parametric analysis. This is just a fancy word for saying that I've been using the actual data in the order in which it occurred in history, rather than making any assumptions about how the probability distribution of the data looks. When plenty of data is available, a non-parametric technique is quite useful and reliable. In this case, though, we need to do something a little different. Let's take a look at the distribution of monthly returns for all of the data available from 1968 to the present and exclude all points where the gold-to-oil ratio is greater than 20. This is akin to saying that an investor is best served not holding much gold when it is expensive. So let's take a look at distributions of returns when the gold-to-oil ratio is less than 20. For comparison purposes, we'll also include a distribution of returns when the ratio is greater than 20. Both distributions look fairly similar in shape. The main difference is in the average. The geometric average monthly real return when gold to oil is less than 20 is 0.35%, whereas the average monthly real return when the gold to oil ratio is greater than 20 is only 0.03%. When the monthly gains for gold that is priced at less than 20 barrels per ounce are annualized, it works out to be about 4.3% per year. This is actually a fairly healthy rate of appreciation, and implies that someone who holds gold when it is priced at under 20 barrels per ounce and looks for another home for his wealth when it is overvalued may do fairly well when it comes to safely making it through his golden years. Let's do another Monte Carlo analysis and see what the safe rate of spending would be given the distribution of returns shown on the top. This time, we'll just do a random walk instead of taking the string of returns in the actual historical order. This will give us a better appreciation of what to expect going forward because it will remove the impact of the late 1970s as a starting point from our dataset. And here's what it looks like. It turns out that if we avoid overvalued periods of time in gold, we can use it effectively during retirement. A person with a $500,000 starting value in real terms can afford to sell about $1,510 worth of gold in real terms each month. This is not too surprising, since gold preserves purchasing power. A person can afford to sell about 3.6% of his initial stake each year for 35 years and not run out of wealth. This safe rate of withdrawal is very close to the $1,525 per month that we concluded was a safe withdrawal rate for a 60% stock, 40% bond portfolio. A person who plans to spend his wealth over time should think carefully about this. But I'm not advocating that a person use gold as their sole means of funding retirement. There are other investment vehicles that provide some very attractive features for managing the risk faced by someone who needs their income to last. Let's go back to our graphical actuarial table from slide 1. We can see that the average male, age 60, can be expected to live for 21 years. But we also know that the investor had better be prepared that he or she may live to 95. And thus, the funds must be sufficient to last for a while. If the person retires at age 60, the funds need to last for 35 years, regardless of volatility and performance. If a person retires at age 65, their funds only need to last 30 years instead of 35, but still, the same principles apply. This means that a person in stocks and bonds can draw down their portfolio by 3.7% of its initial value in real terms annually. A gold investor can draw down his stack by 3.6% in real terms of its initial value annually. And this low rate of withdrawal is mainly due to the fact that the investor is taking all of the risk that he or she may live longer than expected, and also taking all of the risk of investment volatility. But gold, stocks, and bonds are not the retiree's only choices. If a 60-year-old male purchases an immediate annuity contract from an insurance company, then the yearly payment the insurance company makes will be based upon this information on this life expectancy chart, as well as the prevailing interest rate. For those who are unfamiliar with what an immediate annuity is, it's a contract with an insurance company whereby a certain amount of money is provided to the insurance company up front in return for a guarantee of a certain yearly payment up until death. The insurance company will gradually return the person's payment to them and will generally include a small rate of return. The insurance company will invest the money and make a profit doing so. The profit the insurance company makes is this investment return, plus the reward for taking the risk that the individual will live much longer than the actuarial table indicates. But at the same time, the insurance company may also benefit if the individual dies early. Over a large enough number of contracts, the number of people dying late will balance out the number of people dying early, and so that's not really much of a risk to our insurance company. It is the annuity contract that allows the individual to not have to personally assume the risk that he or she will outlive his or her money. So it's kind of like buying a pension. Most people don't realize that they can do this, but they can. And there are many other features that can be baked into annuity contracts, but I don't want to go into them here. The important thing to note is that a 60-year-old can buy an annuity contract and not only guarantee himself that he will not run out of money before running out of life, but can also spend much more in retirement. For someone who has $500,000 of wealth saved up at age 60, it's the difference between being able to spend $25,000 to $30,000 per year safely versus only being able to spend $18,500 per year safely. It's a big difference in available funds for someone who wants to guarantee that he does not outlive his money. So let's tie all this together. What I hope I've successfully demonstrated to you is that uncertainty really is a problem for the individual who wants to plan for living off of his wealth in retirement. The person's spending needs are very real, and many of them cannot be deferred in a year where investment returns are poor. Consequently, an investor needs to be very conservative. Guaranteeing success requires starting with more funds than you think that you'll need, or alternatively spending much less than you'd like to spend. This means spending about 3.6 to 3.7% of your starting wealth annually of what the initial portfolio balance is. Gold can be used just as effectively as financial assets for this purpose, provided that gold is not held when it is expensive in real terms. But there are approaches that can really help the individual. Large and reputable insurance companies are much better able to handle uncertainty. In fact, that's how they make their money. They offer contracts known as annuities, which are like pension plans that you can buy with your own funds. Because the pension plan is averaging over a large number of people, they can take the risk that you'll live longer than expected, because for everyone who lives longer, there will also be someone who dies earlier. So the income that you'll receive from an annuity contract is likely to be much higher than what you'll get if you spend from your savings. Of course, you'll have to become comfortable with a certain amount of counterparty risk. This can be handled by picking the most solid insurance companies and maybe buying annuities from more than a single insurance company. So here's my approach. I'm going to calculate my minimum spending needs in retirement and buy annuities to guarantee that that minimum standard of living is met and sustainable. Any additional funds will be kept in gold. This will provide protection against currency failure, and it will also provide a private means of passing along surplus wealth to my heirs. I know that this video had quite a bit of complex information in it, but I hope you found it useful. Please feel free to have conversations in the comments section. We're all here to learn from each other.